Everyone. Good day, depending on where you are, which time zone you're in. Thank you so much for joining us for our Money Matters series. We still have some people trickling in, but we're really excited today to talk to you about Series A, B, and beyond. I'm going to briefly share my screen and introduce our panelists for today. Yes, everyone can see my screen. Yes. Thank you all so much for joining us. We're excited today to chat with you. I am going to introduce our panelists, and then I'm going to let Sharon and our panelists take it away. So I'm going to start off with Joel Cantor. In 1987, Joel began consulting for a Chicago-based venture capital firm interested in the innovation emerging throughout the Southeast and led efforts for them in the region. Ultimately, he was promoted to president, and over 13 years, the firm invested in some 300 plus startups in the healthcare field. Notable investments included the first LTAC hospital, assisted living facility, and Alzheimer's unit in the country, the first multi-state chain of tattoo removal clinics, and the third largest veterinary clinic company in services, the first orthopedic company to use titanium, the first multi-channel infusion pump, and the now third largest dental implant company in the world in devices, and multiple life science companies. The firm also assisted Plax mouthwash, Sonicare toothbrushes, and the Clarisonic facial brush in the consumer sector. Next up, we have Harris Jones. Harris Jones has had an extensive career in telecommunications, entrepreneurship, venture capital, and international enterprise leadership roles. He spent 5 years as an operating partner with Adams Capital Management, the Pittsburgh region's largest venture capital firm. Harris is also managing director of Swallow Point Ventures, a Pittsburgh-based technology growth investor. SPV targets capital-efficient digital technology businesses and invests in SaaS software, IT, mobile, energy, and mobile companies. In addition, he has a BA degree in public policy from Tulane and an MBA from the Darden School of the University of Virginia. Next, we have Ken Odom. Ken Odom is co-founder and chief executive officer of E4 Holdings Incorporated, a holding company with interest and operations in software, technology-enabled services, industrial services, environmental services, and real estate. A graduate of the A.B. Freeman School of Business at Tulane University, Ken also holds an MBA from the University of Houston System and a PhD from Faulkner University's Great Books Honors Program. Ken has helped lead three greenfield startups, 6 acquisitions, 2 divestitures, and more than 20 million in venture equity raises. Ken has extensive experience in strategic planning, investor relations, venture funding, and startup operations. Last but certainly not least, we have Scott Reamer. Scott Reamer is a capital allocation expert with a broad mix of skills across 3 industries: asset management, consumer packaged goods, and management consulting. As a portfolio manager, he was the chief macroeconomic and quantitative strategist, helping to manage a $4 billion derivatives book, generating significant double-digit returns in 2008 during the most volatile economic period this century. He had responsibility across G7 asset classes, security types, and geographies. Scott built a first-of-its-kind algorithmic toolset from complex system science and information theory, licensing the IP to a CTA hedge fund for international hedging and alpha generation. In total, Mr. Reamer has had more than 25 years of buy-side and sell-side investment management experience built over every cyclical and secular economic cycle since 1993. As a co-founder, CFO, COO of Jackson's Honest, a snack food company with $10 million revenues per year via national distribution, Mr. Reamer helped raise more than $25 million in equity, debt, and working capital, and exited to a PE firm in 2020. Scott is currently a management consultant at RSM, a $3.5 billion in revenue, 16,000 employee global middle market consulting, tax, and assurance firm, where he is a senior director working in the enterprise strategy office. I'm really excited to hear from these experts today, and I'm going to actually stop sharing my screen so we can see our experts in front of us. Sharon, off to you.
All right. Thank you, Jalen. And as you all know, we've brought in the heavy hitters, the big experts for today's conversation. So if anybody has any questions that don't get answered during my Q&A, please put them in the chat and we'll do our best to incorporate them and get you the information that you're seeking. So I'd like to kick it off today with a pretty standard question to set the table. So what distinguishes Series A and Series B and later stage funding rounds in the venture capital landscape? And Scott, if you don't mind kicking it off for us.
Yeah, I'd say expectations and rights and responsibilities. Those are the three big buckets that change between one series and another. The expectations by everyone, but certainly the capital allocators, right? The investors themselves. A company is expected to have a certain level of sort of institutionalization or complexity at each subsequent funding round. The bar gets higher every single time. And then oftentimes the rights and responsibilities of both parties, both the company as well as the investors, change from round to round. And oftentimes, unless you're an incredibly good negotiator, oftentimes to the benefit of the capital allocator, the investor, and sometimes to the detriment of the company. So I would just say those big three things, and would love for the other panelists to disagree if there's a disagreement. But the rights, responsibilities, and expectations are the three big things that change from one round to the next. And indeed, just taking money, all three of those things, when the first money you ever take, no matter where it is, at the seed level or from friends and family, involves those three things: rights, responsibilities, and expectations. And so that's some of the hardest part of being an entrepreneur, is getting used to all three of those things when you take capital from somebody else and partner with them financially.
I see Ken nodding his head. Ken, do you have something to add there?
Yeah, I won't sound nearly as eloquent as Scott. I'll put it in my Louisiana public education vernacular. Series A for us was prove it, right? So we had an idea, we had a concept that on paper looked good, and Series A was so prove to us that it's a real business. Once we proved it in Series A, Series B for us was much more about, okay, now can you scale it? Can you take this pretty cool idea and make it grow at a pace that is acceptable? We've now been through a Series C. Series C is much more of a partnership than for us A and B. A and B was, we're going to give you the money so that you can go do your thing. Series C is, now we're all doing our thing together. So Scott is right with respect to both the rights and the expectations. I would say that once you get to Series C, you're really looking more so for partners who can bring more than a check. Series A and B, all I was really interested in was the check. Get me to my next payroll. Series C, I'm now looking for people who have some expertise beyond just the financial, who can help us to solve some of the complexity that emerges as you scale.
So I think everyone's probably a little curious. What check sizes are we talking about when an entrepreneur has raised their seed round, they got some early money in? What kind of revenue does the company need to have, or how large are these checks if we're talking maybe Series A and B? Harris, do you want to jump in?
Well, I think there's a merge of this answer and the prior question.
Great.
And I think it depends on where you are in the country. In this particular market, kind of the northern Midwest, it tends to be reasonably frugal part of the country. And so people that are just coming out of the gate and, trying to assemble a friends and family round or seed, it might only be a raise of $250,000, and that could be a mixture of incubators and accelerators and friends and family, and perhaps a couple of individuals or family offices that get involved at that stage. More often than not, the businesses are not particularly sophisticated. They are a handful of people with talents. They've got a good idea, and they're trying to take the idea and convert it into a business opportunity. And so that means creating a product and actually starting to see if there's fit in the marketplace. And at that point, then the next step would be proper seed round or Series A. What might be a startup here at 250,000 for their early round of financing. If you're in Seattle or in the Bay Area, that might be 2 to 5 million. So I suspect the answer to your question varies dramatically by region.
Great. And
Right. That's
yes,
something that, I would just say it also varies by field. Because if you're doing something that you are expected to have a product ready for the market relatively soon, then that's going to be the basis upon which you're judged. If you come from the world I come from, where for devices and drugs, you have a 5 to 10 year process before you ever clear the FDA and are able to sell a thing. And so the steps are measured in very different manners that don't involve revenue, but do involve complexity and the kind of resources you are able to bring to the company.
Yeah,
Well said.
and Sharon, can I just add one more thing to that, to what these guys said? I think it's also important for founders to remember that the other component is how good of a salesperson are you, right? Because there is no necessarily defined check size at stages. There's not even necessarily defined gates, depending upon who you're talking to. How well can you sell your vision? Do you really believe it? And are you compelling whenever you pitch it? I found that plays into check size. It plays into how interested various types of investors are in what we've got going on.
Yeah, great point. Sharon, one last point to this. It also depends remarkably on the capital intensity of the business in which that you're starting, right? So a manufacturing entity in the Midwest is going to look vastly different than, a coding company that's got some interesting programmers. The programmers don't need a lot of capital other than their salaries. But if we wanted to stand up a 100,000 square foot facility outside of Chicago, that's going to cost some significant capital, and you have to do that before you sell, in theory, product one. So capital intensity of the actual business is a massive determinant of that as well.
thank you. And so, as many of our attendees know and understand, our panelists today are members of our Green Wave Innovation Network, and therefore they spend a lot of time mentoring entrepreneurs and helping them reach their goals. And so I was wondering if you could speak a little bit about how you would typically help an entrepreneur, or yourself if you were raising money. How do you prepare for subsequent rounds after your seed round? What is it that you need to do? And Joel, if you don't mind kicking that off.
Sure. So in our case, I'd say we try to provide assistance in a lot of ways. I mean, some of it is what the presentation ought to look like. Some of it is how they're delivering it, how they're answering questions as you sit through a few of those meetings with them. I think that they need to give a fair bit of thought and study to what they're going to do with the money, and have great explanations of that and the vision of where it really goes and why this is important. And I think for the most part, you have CEOs who either came out of academia or, had this idea somewhere or another and have never really done this before. They work someplace else, but never run something and been responsible for it. And it is a big learning process. And the more people you can surround them with that have some domain expertise in some aspect of what's being done, at least our experience is, the better off they will do in learning and the better off the company will do in succeeding.
Does anyone else have any notes on preparation?
Yeah, so data. It is shocking how much data investors are seeking, some of which you may or may not have, depending upon how much time you've devoted to building out the systems to enable that. I think it was a surprise for me, and I think it's a surprise for everyone, just how much work it is to provide the information that investors will require. In our case, I almost had to, it almost became my full-time job, and my co-founders had to run the business while we were in the midst of the due diligence process. Now, investors will attempt to help you make the due diligence process easier, but the bottom line is you're the only one who knows your data. You're the only one who can contextualize it. So you've got to be willing to put in the cycles. So it's not something to be taken lightly. It's not something that you do in your spare time. It becomes a key component of your job.
Which really leads me to sort of my next question, which is, I guess, in addition to coming up with all this data that you may or may not have, what are some other common challenges that startups face when they're trying to raise Series A or B?
Darren, can I answer that?
Yes,
Yeah.
please.
Yeah, so my particular bias, so I've been on both sides of that table, right? I've begged for capital and allocated a bunch of it, and one is very much easier than the other, as you can imagine. And so I take the view, part of the challenge that I try to help folks with is to understand what is the real capital need here, and how do they optimize the capital against what their goals are, right? So one could give up 99% of the business and raise a ton of money in theory if it's a good idea, but really then you're just working for somebody else, right? You could go and work for a large tech company and have the same sort of optionality, the same sort of stock options as that. So that doesn't make a ton of sense, but not taking any money and owning 100% of something that's small and not very valuable, that too is an extreme that's not optimized. And so there is some optimization in between there. And I in my experience, I don't think a ton of entrepreneurs actually sit down and think of that. They just think, gosh, I need $250,000 to get to value creation timeline 1 in their brains, or whatever that goal is, whatever that KPI they've developed. It's 18 months out. I need $500,000 to get there because I'm the sources and uses statements look like the following, and that gets me to 18 months from now. But I don't get the sense that a ton of entrepreneurs think intentionally about what the paths to that 18 months can look like. There's not, it's taking $500,000, yeah, but maybe you can take less and cut down on certain expenses, or change the price of the product, or adjust the margins if possible, or husband some resources, not spend them all up front if it's not ultimately necessary. And so I personally spend a lot of time counseling people on the need for the capital, because everything has a cost, and when you take somebody's capital, you have, again, responsibilities to them, and you lose control, which isn't necessarily a bad thing, as Ken had mentioned, if it's a great partner. And every investor is going to say, yeah, more than just capital. But in our experience at RSM, we have 2,200 PE venture capital clients. I can assure you that not all of them are so inclined. There's a hefty amount of Machiavellian behavior in the capital allocation game. So I spend a lot of time talking to entrepreneurs about what the real need is and how one can optimize that need against maintaining control, finding the right partner, as Ken had said. And sometimes the easy money is the wrong money, and I can assure you that I've seen that a bunch of times, both in my personal experience of having taken sometimes the easy money that was the wrong money, but also seen it on the other side where recapitalizations and other things where companies are trying to basically restructure from some bad capital that they had taken earlier. So I just want to reinforce the point that not all capital is equal, and that the entrepreneurs often don't think about the alternatives that they might have if they change maybe the P&L or their plans or their goals a little bit to perhaps maintain a little bit more control over the entity.
Yeah, and that's an important point that Scott's making, because it's more than just having somebody in your kitchen, which you will. They will be in your kitchen and they'll want to test all the ingredients for you. But once you have that money and then you go start using that money, it can become a slippery slope. You can get out over your skis, grow faster than you should, spend the money poorly, and then you need more money, and then you're facing further dilution. And a lot of these guys, not all of these guys, you find the right partner, they're not like this, but there are some guys who their game is to dilute you out of your ownership over time, right? And so you've got to really guard against that and be really thoughtful about where you're going to put the money, how quickly you're going to spend it, and really, and how much information you're going to share back. How many times are you going to take the advice from the investors? How many times are you going to push back? You've got to get comfortable with those thought processes before you take the money.
Just one other concept there. Quite often in the business development, the growth cycle, there's some natural business stages and proof points that correlate to the amount of capital that you're raising. And if you can get with a group of investors, agree to 3 to 6 specific business objectives. It could be hiring key personnel. It could be launching a product into a defined geographic region. It could be testing price in the marketplace or distribution channels. And you want to know the answers to those questions before you get into that next growth stage. That is, that allows you through your business model planning to encapsulate how much capital would be necessary for that stage. And so you don't dilute yourself too much at that stage. And then the next stage, how much capital you'll need at that time. So there's definitely a very clear correlation between the business trajectory and the amount of capital being requested.
And so how does valuation change as a startup evolves through the process from taking, seed or raising friends and family to something like a Series A or B round?
So I don't know that it is as straightforward as you want it to be, right? because there's a market dynamic that comes into play as well, right? So we're in the SaaS software space. SaaS was riding high through COVID. You could get any valuation you wanted, right? It didn't really matter. There was money ready to go. People were trying to invest. You come out of COVID and the SaaS market begins to dry up a little bit. Suddenly, instead of funding losses, which most people were willing to do, now they're looking for companies with positive EBITDA. And so it's not a straightforward calculation that says, hey, the valuation is X during this round and Y during that round. It's a little bit of a, what does the market bear right now? So I'm sure that these guys have their models that they run, but the market does dictate quite a bit of it.
So I would add a different side of the market, which is all the participants in it that might be candidates to fund your company. And the reality is their attitudes also change. So if they are high net worth individuals or family offices and they were expecting that public offerings would be done for a dozen of their companies by now, and they would have cash back from something that they had invested in 5 or 10 years ago, and they don't, they're going to react very differently about valuation or even saying yes, or even taking the meeting than they might have. And to the point that was just made, right before COVID to right through 2021. I also think a lot of it is sort of what is the breadth of how you are going out finding investors, because most entrepreneurs, frankly, don't have a Rolodex full of high net worth individuals and family offices to go to. And so you're basically going and having meetings with anybody who will take one with you and hoping that maybe they'll say something positive and maybe they will at least refer you to somebody else they know because they thought it was all pretty interesting. If that's how you're really going out raising money, it's hard. I mean, you're getting way more no's than you're ever going to get yeses by a pretty substantial margin. And it takes a lot of time to do all of that. And the reality of that then is you have a lot of people out there who saw your business plan. So, when you go back out the second time, how well you hit it or didn't hit it, because if you're 2 years late on achieving that milestone you told them about 2.5 years ago, it's not going to bode well for your ability to convince them to suddenly come in, on round 2. And so I think there's just a ton of emotion in all of this on both sides.
Joel, I'm so glad you brought up family offices. We get asked this question a lot because I guess this is not taught in curriculum the same way that getting money from an incubator or an accelerator or a traditional venture capital firm might be. Can you talk a little bit about family offices, how they work, and maybe how entrepreneurs can find them?
Well, I can talk about the first couple. I can't talk about the last one. So I think a family office is generally somebody who did make a lot of money at some point in time. They want to pass it down generationally, but they want it to stay basically together. And so it's not like when the patriarch or matriarch dies, you're just going to divide it all up among the siblings, the kids, and however many generations, and then just everybody goes off on their own. And so the family office structure allows you, from an estate's perspective, but also from an asset keep it together perspective, to basically put together professional staff that will manage the money in a way that the family has agreed to, and hopefully continue to grow it and achieve their philanthropic objectives as well over a period of time. The difference between them and sort of what I would call high net worth individuals is probably just mostly the amount of money and the number of generations that might be involved. There are obviously people like the Rockefeller Foundation who have been here for well over a century, and continue to have a lot of money and give a lot of money away and invest a lot in a bunch of different things. I think the issue is there are lists of where every venture capitalist in the country is, or where every fund is, and you may not get a response, but you can get to them. High net worth individuals, there isn't really a list, but everybody knows some. And, if you start parading around that world and angel networks and whatever, you will end up meeting more and more of them. And, those are the kind of people you really want to talk to get something between, 25,000 and $250,000. The family offices, my experience is they are the most secretive people on the planet. There are several national organizations to which many of them belong in order to have exchanges of various sorts. Those organizations guard their membership lists as if it was Fort Knox. And so unless you get somebody who knows a bunch of those folks and will help you with introductions, it's hard. It's really hard, and way harder. It may not be harder to get in than it is with a VC. But at least the VC, there was a place you could get an address and a phone number.
Yeah. So Sharon, I agree with everything Joel said about family offices. They're very hard to find. The only success that we've ever had getting in front of family offices was to contract with an investment bank, and an investment bank will represent you to their network of potential investors. Many times those include family offices. Now that comes at a price. They charge you a percentage of whatever they're able to help you raise. And typically, I wouldn't engage an investment bank until I was much further down the line, right? A Series C, a Series D, maybe something like that. But that's really the only way that I've ever found to reliably get in front of family offices. Other than that, it's, as Joel said, you build your network and you network and network and network, and somebody knows somebody, right? Otherwise, it's really hard to find family offices.
Sharon, the two databases, just to be specific about it, the two databases that we've used historically, these are just to understand the names and the places and the assets under management and such. It's not to get in front of them. For that, you have to find some personal link, or 2 degrees of separation kind of link. One is Prequin, PREQUIN.com. It's the oldest and the one that we've used. The other one's FinTRX, FINTRX.com. Both are pretty expensive. These are not like free things, but maybe you find somebody that has access to it, or a friend of a friend or whatever. But those are pretty comprehensive databases with names, addresses, telephone numbers, email lists, and AUM under management.
Thank you for demystifying that for all of us. But I know there is definitely alternative funding options available to startups besides traditional venture capital. And I'm wondering if you could speak a little bit to what are some of those alternatives and some of the advantages and disadvantages. And Harris, if you want to kick us off.
Sure. Well, the best types of alternative investors are those that are non-dilutive. So to the extent that you can go find government programs, there could be research grants. Absolutely the best types of financing out there because you don't have to pay it back. And quite often, if your business is oriented in the direction of some sort of research base that lines up with some of those entities. So, you know, in this region, we see a lot of very technical businesses that generally are looking to DARPA and other federal programs to fund the businesses for the first couple of years while a product is under development. Beyond that, you know, we talked earlier about accelerators and incubators. They tend to have very entrepreneur-friendly capital, convertible notes that tend to be not as intensive with respect to their oversight demands and board governance requirements. But there's capital that you don't have to face down the challenge of valuing a business at its very earliest stage in a convertible note, and it allows you to take the first couple of steps in terms of getting that business off the ground.
Yeah, I'd say the Small Business Administration, we've never dealt with it, but I know from other entrepreneurs that have is can be a good source of that, SBIC loans, et cetera. I would also note that, you know, the Biden administration the United States basically has a de facto industrial policy now for the first time since the end of World War II. And you know, the number's $2.3 trillion all in relative to the CHIPS Act, the Inflation Reduction Act, the infrastructure bill, all of which have been passed over the last 3 years, 3.5 years. So the navigation of that matrix is really challenging, but those monies are available. The tough part and the good part, as Harris just said, is that oftentimes they're non-dilutive. There is a cost to that, and the cost is a bureaucracy, tracking down the right people, providing all sorts of crazy forms, of course, a delayed timeline to funding, almost certainly, versus, say, private sources. So it's not without costs, but if you have, you know, the appetite and the patience to go down that path and navigate some of the bureaucratic matrix, those can be, you know, worthwhile sources if say family office or traditional institutions, PE or venture capitalists are finding your story challenging for them to digest and metabolize. Just get in front of them, you know, that might be a path to explore for sure.
That's a great point. And Jalen, do you want to let our audience know a little bit about the resources that we have at the Tulane Innovation Institute to assist with some of this grant application and demystifying the government funding piece?
Yes, so here at the Tulane Innovation Institute, we have strong connections with the Louisiana Tech Transfer Office. Basically, whenever we ask, they will come down or put on some sort of programming to talk about SBIR, STTR funding, and all of the processes for that. We have their phone numbers, so we're more than happy to connect anyone in this chat or anyone who may be watching this recording. Please just email us. Don't hesitate to reach out.
Thank you. Yeah, I think it's really important, obviously, that we tie our conversation to the resources over at the Innovation Institute. And we also have Tulane Ventures. Our check sizes are going to be between $50,000 and $250,000. And I'd like to think that our term sheets are also pretty entrepreneur friendly. And we are looking specifically at companies with ties to Louisiana. So hopefully the information you're getting has all of your wheels turning on how you can come up with some funding to scale and grow your business. So I'd love to talk a little bit about revenue-based financing and debt financing and how that compares to equity financing from a VC. So does anyone want to help demystify that?
Yeah, we did this. So, you know, at Jackson's Chips, Jackson's Honest, Jackson Chips now, we did this, and it was actually super helpful, you know, because we had payables from pretty large companies, you know, Whole Foods and Costco and a bunch of, Kroger, et cetera. And so instead of, using expensive equity capital to, produce $500,000 worth of product to sell for, $750,000, $850,000, I negotiated a working capital line of credit that I didn't have to put a personal guarantee on, which was sort of the thing that we definitely wanted to optimize for. And so that actually helped us fund the cost of goods sold financing that, particularly a CPG company needs. Again, it all depends on your business model, whether you have a significant, what your cash cycle is, your product to payment cycle. So there's tons of variables about whether or not that makes sense for your business. But it like any other capital source, it can be completely vulture and Machiavellian. Factor financing, for instance, can be really super aggressive, bad for you and good for the financier. It depends entirely on the provider. Basically, we went with a firm out of New York who has done this for very large, fast-growing CPG companies, and we were a couple hundred basis points over LIBOR at the time, and so it wasn't terribly expensive, and certainly absolutely worth it, so that we could husband the equity capital for capital expenses that were strategic in nature and would pay off over 6, 9, 12, 18 months. Rather than new products, for instance, rather than just funding a 75 or 60-day product cash cycle. So I'd encourage people to learn about this, regardless of whether you need it, because it's really a nuance of the cash flow cycle that is important for you to understand. So it'll be representative of a lesson you need to learn regardless of what your business model and your cash flow cycle look like. But it's not for everybody. And if you're uninformed, and you're the sucker at the table, you can get really taken advantage of. So you really, if you're going to go down that path, really learn about it and be informed about the dynamics and the usual pricing, et cetera, Sharon.
Yeah, and Sharon, there are entities out there that specialize in what they call venture debt. They're kind of a combo package between what a VC would look for and what a bank would look for. So it's non-dilutive financing. Normally, the payment terms are pretty favorable to your cash flow position. However, the interest rates are really high. So you're paying a premium for that debt. And often it doesn't really make sense to look into it unless you are EBITDA positive or getting close to being EBITDA positive. However, it is something, so somewhere around B, when I was thinking about my B, and then definitely beyond B, venture debt became more attractive as an option, especially since, circling back to that previous conversation, we became much more sensitive about how much we were going to be diluted in subsequent rounds. So it's something to consider, but it does have its costs associated with it.
Yeah, I think really early on, well before A or B, there are some, I think, attractive programs to the SBA that offer some pretty low interest rate loans. And I think, as we're always trying to encourage all the entrepreneurs that we work with to try to hold on to as much equity as early as possible and to really try to grow their business and to get cash flow moving. But, as Joel alluded to, when you're talking about something in healthcare or medical fields, the road is so long and can get so expensive that unfortunately, that's just not always possible. And so all these business models that we're referring to and different kinds of business really do sort of dictate which direction and which lane is even open to you. And so that's super insightful. So we talked a little bit about all these different kinds of funding. So do you recommend that entrepreneurs shift their growth trajectory to align with the expectations of their funding partners? Scott has an opinion. You can tell by the look on his
Absolutely
face.
Joel, you go
Everyone
first,
has
but
an opinion.
yeah, Joel, you go first, but that is a weighty question.
No, because again, I think the most important thing that you do is achieve what you say you're gonna do. And so if you're shifting it just because it's gonna make them happy, when you miss, everybody is going to be very unhappy. And the worst part of it might be that they just refuse to put up any more money. I think if anything, I would go the opposite direction and sort of design your expectations such that, or what you hope they will believe to be the expectations, to be something that you believe you can beat. Because by far the best success you're going to have in getting the next round done is beat the timeline or beat the goal achievement line. And not only will you have something to go out and herald to the people that you had seen before, but the people that have invested are going to love to talk about you to all of their friends.
So
Yeah, it's an old adage that goes, raise money when you can, not when you need it. And to the extent that you've got some momentum in your business, that's a good time to go raise capital, because you can exhibit all the metrics and the data points to exhibit the growth. There have been a number of references to the Machiavellian nature of venture capital, and unfortunately, many investors will look to pounce on situations, particularly when it comes to the valuation question. When businesses are up against the wall, they don't have existing investors that are willing to continue to fund the business, and then things can become very dire. So it's a very nuanced question, and probably one of the most challenging answers that you're going to have to come up with during the course of the evolution of your business.
yeah, I think it all sounds good in theory, right? But the reality is, for many of us who are entrepreneurs, you get used to working for yourself and you set that pace. Once you have an investor, you no longer strictly work for yourself. And so there is a give and take and a conversation. They have their own expectations. Often your investors are getting their money from someone else who has a return expectation. And so it's not as simple as saying, no, here's where I draw the line. I'm going to grow this fast and no faster. It's actually much more of a compromising with their expectations relative to your expectations. So it's a relationship.
So my comment to this would be, I've seen as many companies fail because they grew too fast as failed because they didn't grow at all. And taking money, so the nuance here is that you have to invest the capital you're given at a higher rate of return than it costs you. And so that is basically what entrepreneurs are paid to do, right? The return on invested capital higher than the cost of capital. That's it. That's the equation. And we can talk about this some other time, but because it's nuanced. But I've seen companies spend capital like drunken sailors, grow the top line massively, beat everyone's expectations. And to Joel's point, everyone's talking about them, but they were destroying enterprise value the entire time. And then eventually realized, gosh, we're in a position, to Harris's point, where, gosh, we need a hell of a lot more capital now just to stay afloat, right? Versus having made the choice to grow slower earlier. They would have husbanded capital, actually produced perhaps some positive cash flow, gotten profitable. So the reason it's challenging is that it's bespoke to every specific business and the competitive ecosystem in which they operate, the P&L, the structural profitability of their business, both at startup and then at scale, and then transition to that. There's so many variables that go into this, but the one that I keep coming back to is that stat where I've seen as many businesses grow too fast and fail as not grow at all and fail. And it's a function of putting capital to work that is uneconomic, that is at a lower return than it costs you. And when you do that, doesn't matter if you grow fast or don't grow at all, you're going to go out of business and or going to need a heck of a lot more capital from somebody who's probably not as willing as they were in the previous round. So this is super subtle and sort of the black arts of being both an entrepreneur and as a capital allocator. But suffice it to say that this is extraordinarily nuanced. The solution is to keep control of the P&L. We almost grew out of existence at Jackson's. We went from $0 to $10 million in 18 months, and it almost put us out of business. And I hold that lesson like the greatest generation does of the Great Depression. That I have money in cans in my backyard, the equivalent of that. So I'm very sensitive to growing too fast, and so I'd rather have control of a business that's moderately profitable and growing 3, 5, 7% than no control over a business that's growing the top line 50, 60, 70% year over year, but losing money hand over fist. That one of those businesses is sustainable, the other is not.
Yeah, so I think
And to throw in a plug for the Innovation Institute, the mentorship program, I think, is a terrific example of how entrepreneurs can avail themselves of non-vested advisors that can help them think through some of the subtleties of this challenging question. As much as in my experience on both sides of the table, as much alignment as you'd like to believe there is at the board between the entrepreneur and their investors, quite often they do have different objectives. And therefore, it's really important to have access to some independent advisors that can help you think through this question and get to an answer that works for everybody.
Thank you for that. And just as a friendly reminder, if you are seeking mentorship, we can assist you. And so you can always reach out to myself or Jalen to be connected with some of these wonderful minds that we've invited to speak with us today, in addition to the other 63 people in our current mentor network and growing by the day. So I guess the overall theme for the answer to the last question is we should be under promising and over delivering all the time, while also making sure we don't outgrow ourselves and our abilities too quickly. So that was great advice. And so I think the last question before I open it up in case any of our audience members has a question is to talk a little bit about company culture. And so when you have a startup and you do take on investment and you are growing maybe at a pace a little more quickly than you were before the checks rolled in, what does it do to company culture, and how do you maintain company culture in a startup during that growth phase?
It changes expectations, I think. So for many of us, it was, our own passion project that started it, and we started it with friends and family and people who were like-minded about that passion. And that's one sort of culture. When external third parties come in, they have their own sets of expectations. Often they're expecting you to run the business in more of a, I guess we could call it, industry standard way. And so it certainly changes the way that you hold some of your employees accountable. It changes some of the metrics that they'll be looking at on a daily basis, because you'll be looking at them on a daily basis. So it is a change management thing to navigate when you do that. It doesn't have to destroy your culture. It shouldn't, but it does raise the bar with respect to how you operate.
Anyone else want to add to that before I open it up?
I'd only add that, the way we ran businesses, either as allocators or entrepreneurs, would be the culture is the other side of the coin to incentive, right? And so the incentive can, get people to do wonderful, awesome things, 60-hour work weeks, regular holiday, working on holidays and nights and weekends. But culture is what sustains a startup. And to Ken's point, the culture can change because the incentives can change positively or negatively when you have capital partners in the capital table. And so you can sort of immunize your employees from that, or embrace them, have them embrace that. And we took the latter. So we involved all of our employees in the board meetings and with regular updates with our institutional shareholders and things like that. So you can take either tack. Neither is right nor is either wrong, but to consider it as two sides of the same coin, one being incentive, the other being culture, and managing the balance of those two things is really one of the, again, the dark arts of running a business through the growth phase, the tween stage.
Yeah, we always want to make sure that we have autonomy. And I think obviously when you add people to your cap table, that definitely brings into question the autonomy that you maintain in the running of your day-to-day business. And I think a lot of times if you're an early employee of a startup, you really bought into the entrepreneur's passion for the problem that they were solving. You really saw them as the leader that could get this done. And I think that's usually you got on board for the journey because that's who you believed in. And now there can be multiple bosses at the table when enough people enter onto that cap table. And it does, I think, change the way that early stage employees and entrepreneurs control the situation. And so this was really, really fantastic advice as a lot of our startups are sort of navigating that first money in and planning for their future and how they will get to the growth stage. And obviously, we want to be here to support them through the whole journey, but we want to paint a really realistic picture of what that's going to look like and try to give them opportunities to learn about as many options as there are out there so that they can make the best decisions and plan the best way possible for their startups. So I just wanted to open it up to anybody who attended who might have an additional question. I think we did a really good job of covering a lot of topics because we had a very, very quiet group today, or everyone's shy, or maybe is all stuffed out from a huge Passover Seder last night. I'm not quite sure. All right, so since we do not have any audience questions, I am going to toss this over to Jalen, who is going to tell us about some upcoming opportunities and close this out.
Thank you, Sharon. Okay, so once again, thank you all so much for joining us. I personally came away with quite a few nuggets. Series A, prove it. Series B, scale it. Series C, partnership. Another nugget was data. That's what the investors really want the most. I think the proof points or business objectives piece was really, really valuable. We learned about family offices and how elusive they can be. We also learned the adage, which maybe we print this out, put it on a poster: raise money when you can, not when you need it. So once again, thank you all so much for joining us. Would like to give a brief shout out to some of our upcoming Tulane Innovation Institute programs. Currently, we have the Tulane Research, Innovation, and Creativity Summit, also known as TRIX. That's going on April 23rd through 25th. It's happening uptown at the Lavin Burnick Center Student Union. So definitely come check us out there. Also, tonight we have our Faculty Innovation Mixer. It's a free event open to everyone who is interested in research and collaboration among faculty at Tulane University. Once again, obviously we've got our Money Matters panel. We've got open mic night tomorrow, our Medical Innovation Challenge. And then next month, please don't miss out on our Startup NOLA Happy Hour. That is a monthly startup ecosystem event that we are holding at the Broadside NOLA, and keep an eye out for our emails for more information about that. Thank you all so much for joining us. Once again, my favorite picture of myself saying peace out, and we'll see you at the next webinar.
All right, big thank you to Joel and Ken and Scott and Harris for joining us today and sharing this wisdom and allowing me to record this because I think it's going to get a lot of requests. And have a lovely day.
Have a good week, everyone.
Bye, guys.
Cheers.
Thank you, everyone.